All right, everyone's going crazy over the stock market right now. And by the way, this is a training video, so if you agents are using this to close somebody or sell somebody, you're doing it without my permission. You can use it if you want to, but this is just information for the agents on our Facebook group, okay? So the stock market is going up, it's going down, it's going sideways. Lots of people are asking me, financial architects, hey, what's this all about? What are they talking about, etc. So this is going to be the 101, if you will. On the 6th of March, we have another full-timers meeting. Actually, we have another area-wide full-timers meeting on the 6th in Chino Hills. So you want to show up to get a little bit more information about what I'm going to talk about. Now, I've brought up here the, you don't have to zoom in yet, but I brought up here the S&P and I brought up the Dow Jones Industrial Average, okay? So, Stock 101. There's two different types of things that are happening in the stock market. So there's stocks and then there's bonds. Stock is ownership. So if I bought $1,000 or if I put $100 into your company, let's call it XYZ company, and I go, hey, here's $100, I want to buy stock in your company. And let's just say the first year your company drops by 10%, your company profits drop by 10%. I'm gonna lose $10. So I would have an account value of $90. The reverse also happens. So let's say my company goes up 10%. I've made $10 in stock. So stock is actual ownership. So if I buy into Starbucks and Starbucks goes out of business, which is not happening, then I'm losing $100. So already you can already think to yourself, oh, well, if I were to buy stock, I'd probably buy into Apple or Microsoft or all these big companies, okay? The chances of you losing all your money are slim and none, in my opinion. The reverse to that is a bond. So stock is ownership inside of a particular company. So I could buy international stock, which is outside of the United States. I could buy a domestic stock, which is internally here in the United States. I could buy a stock, a Starbucks stock, or an Apple stock, or XYZ or ABC company stock, okay? That's ownership, so you have risks, lots of risk. A bond is gonna give you a guaranteed interest rate. So if I grab my $100 and I give it to your company, XYZ company, you're gonna say, hey, thank you, I need money. You're gonna give me $100 and I'm gonna give you a 2% return on that bond. So corporate bonds are big. You know, corporate bonds are yielding like 2 3/4 or 3% corporate bond. Treasury bonds, the government's very secure, so you know that your money is very secure. So what happens is the more risk, guess what? The more reward. Less risk, less reward, okay? So that's the difference between a stock and a bond. So somebody has a mutual fund portfolio where it's diversified in tons of different stocks and bonds. Normally what you'll ask them, if you're an advisor, you go, what's the reason why you had diversified portfolio? They're only gonna give you one reason, and they may even go, I don't know. They're gonna say to avoid risk. It diversifies and it helps with not losing a ton of money. If you're trying to do that in a diversified portfolio, why wouldn't you just invest in an index? That's what everybody keeps talking about here, okay? So I'm following notes, and as you can see, this little pie graph that I leaned out, that's an example of an asset allocation. So I have XYZ company, I have Starbucks stock, I have Apple stock, I have Texaco, Nike shoes, I have all this diverse portfolio of stock. Now, here's what's crazy. If you ever pick up that book, Money by Tony Robbins, he says in the book, 96% of the time, the Standard & Poor's beats out an asset allocation, 96% of the time. So why would I pay 5%? I mean, it ranges anywhere between 3 and 6%, but why would I pay 5% to a money manager and have them invest my money when I know 96% of the time the index is going to beat it? Now, there's two indexes I want to share with you. One is this Dow Jones Industrial. Go ahead and zoom in. So one is this Dow Jones Industrial. Now, if you see here, this is the 1 day. This is the 1 day trading in the Dow. See how it's super up and down, super up and down. It's very aggressive. It's you're losing 1 hour and you're sunshine the next hour. Okay, I'm gonna go to the 5-day. This is what's been happening the last 5 days. So it was super. This is the top. This is the highest it's ever been, ever, right here. And it plummeted and went back up, went back down. I mean, you had 2 times in this week. It went over 1,000-point drop, almost 1,200-point drop on Monday. But it's pretty aggressive right now. This is the Dow Jones Industrial. I'm going to show you another index. So when they talk about indexes, it's a bunch of companies. So the Dow Jones consists of 30 different companies or 30 different indices. So that's one index. The NASDAQ is another index. The Hang Seng, another index. These are all different things or different indexes. If you want to learn more, you can go straight to Google. You can Google all this stuff. The Standard & Poor's is the top 500 companies on Wall Street. So let me show you the same thing. This is the 5-day, okay? Up and down, super down, right? People are real concerned right now. I get calls all day long and all they want to know is this stuff right now. This is the 1-day, look at that. You're a hero of 1 minute and you're a zero the next. You want to see the 5-year? Boom! Look at that. It's gone up. Last 5 years, it's like everyone forgot about 2008. The last 5 years, it's gone totally vertical. Look at that. The peak of the market was just probably a week ago, and now it fell through the roof. Look at that. It's dropping like a brick right now. So here's what the Standard & Poor's 500 is. You ever get these guys, like I used to work for Transamerica Financial Advisors, and I used to present to thousands of people, and I'd put, well, the small cap index and blah, 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 and no one understood me. Here's what it is. The Standard & Poor's 500 is the top 500 companies on Wall Street. So have you heard of Facebook? Have you heard of Microsoft? Have you heard of 3M? You heard of Chipotle, McDonald's, all these big, bad companies. So imagine putting your money in the top 500 companies in the United States, in the #1 economy in the world. That's how secure this thing is, right? And even then, people are like, oh, damn, I'm losing money. That's what happens. What goes up must come down. So a couple different things on this subject before I move on, okay? So the Standard & Poor's 500, that is, in pure definition, in my opinion, a diversified portfolio. Again, why would I pay my stockbroker or my mutual fund advisor or some Primerica guy, nothing against them, why would I pay them 3 to 6% when I can just go put my money in Fidelity.com and get an S&P return for free or for 30 basis points versus 5% of the portfolio? So if I put in $1 or if I put in $100 and I'm paying a 5% fee, already I'm losing $5. So if you have your money in an aggressive asset allocation right now and you see your money going down consistently, you're not just paying for the loss, you're also paying for the advice of somebody that told you to lose. I could lose money great on my own, so I might as well do it for free. So in this S&P 500 index, you're gonna get pretty much the average of all the other companies out there. All right, so that's number 2, indexing. So here's what I'll tell you. If you're younger and you're 25 and you're 35 or 30 and you're building your career right now, yeah, you should be aggressive, because the thinking is if you're dollar cost averaging, you keep putting in a certain amount of money when the market is up or down, eventually the market has gone vertical. So when that happens, you have enough time to recapture your gains. But if you lose 10% on the market, you have to get 20% just to get all your money back. That's a fact, okay? So whether you're doing that, you really have to take into consideration your risk tolerance, whether it's moderate or aggressive. If you're conservative, you should not be in there. And then you have to think about, am I 5 to 7 years from retiring? If you're 5 to 7 years from retiring, you should not be in an aggressive asset allocation. You shouldn't even be in a moderate asset allocation. You should be in something more fixed, and you should be looking at something that has the returns when it's good and no loss when it's down. Yes, that's out. The returns when it's good and no loss when it's down. You're still there, okay? So that's very important, is where you're at in life. Almost done. So a couple different things. When people see the stock market dropping like a rock, guess what they do? They start calling their stockbroker saying, get me out of the market. And when they get out of the market, it causes the dip to be a little bit more aggressive. I wonder who's going to retire in the next 10 to 12 years. That's right, baby boomers. So when you have 81 million Americans that are all going to retire, these guys are going to retire. That means that all of the wealth is going to be pulled out of these stock accounts, and eventually the stock market will deplete or will go down, excuse me. So when that happens, obviously you don't want to be anywhere near that bubble. Now, is there a bubble? I don't know. I'm not Nostradamus. Will it come back? I don't know. Historically speaking, yeah, just like real estate. Well, Manny, I bought a piece of property in 1980 for $78,000. Yeah, well, can you buy that same piece of property now for $78,000? No, you can't. But at the same time, you don't have marble, you don't have pipes, you don't have all the different things. So just like inflation goes, so does the stock market normally. If you're getting a 1% rate of return at your local bank, you're not even outpacing inflation. You might as well spend your money now, okay? So a couple different things. I'm in the life insurance and retirement planning business. We just got an email recently. Life insurance companies one company is cutting their fixed rate. When that happens, there's a lot smarter guys at insurance companies than I am. So when they cut their fixed rate and they cut something called the cap rate, when that happens, they're projecting something big. So food for thought. Another thing is I've come across lots of different client scenarios. Recently, I had a client come in. He's 62 years old and he's still in aggressive stock. And I said, what is the purpose behind this money? He says, I need to live on that. So I need to make sure that I'm getting a certain amount of returns so that I can live on it for the rest of my life. I said, sir, if you're looking, with all due respect, if you're looking for a guaranteed income stream, it's not in the stock market, it's more into annuities. There's lots of other products out there to get involved into. The only reason why lots of us, majority of us, are in our 401ks and our IRAs is because we don't know anything else but that. And you guys put in 3, 5, 7. I've seen people put in $1,200 a month into their retirement funds, and they don't know 2 things about it. I ask them, hey, on a scale of 1 to 10, how informed are you about your current 401k? They go, I have no idea. And then they wonder why they're 52 years old and they're what? They tax me on this 401k? Yeah, duh. So get informed. So the agents out there, that's all that I have. Hopefully that gives you a little bit, I'm passionate. Hopefully that gives you a little bit more information. That way you can discuss it with your clients. And guess what? We live in an information age now. 11 years ago, YouTube wasn't even out. Now it is. So you can go right to YouTube. I might just put this on YouTube. So you might go right to YouTube and you punch in all these questions that you got, and guess what? There's probably a video about it. Some of them not informed, some of them informed. You can go right to Google and you can punch in anything and you can learn about all this stuff. So hopefully that helps you out. You guys have anything else? Don't write it down, just tell me. What else?
Tell them to subscribe to your YouTube page.
Oh, subscribe to my YouTube page. It's right up or down. I don't know where they're putting it. Oh, we got a video person that I just hired, and she's awesome. She's going to put all these videos on YouTube. I'm deleting a lot of my other YouTube, so take care. Stay tuned. Our new office is coming too. See ya.